Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery in for Dave Briggs. Let's talk about today's market action with an hour to go in the trading day. You're looking at gains almost across the board. The Dow up 359 points. That's a 1% gain. You're looking at the S&P up just about 0.9%, closer to that 4,000 level. Nasdaq 100 up just around 0.6%, up 75 points. Some buying activity ahead of the inflation print that we're getting tomorrow morning before the start of the trading day. And then also the Fed decision on Wednesday where they are largely expected to raise rates once again. Taking a look at crude, because crude prices are steadying just a bit. You could see it above $73 a barrel. That's good for a 3% move to the upside. Drilling down into some of those individual movers this afternoon inside the Dow, 28 of the 30 Dow stocks trading to the upside. Only decliners here are Merck and Amgen. You're looking at Apple and Microsoft both setting the pace here. Also Boeing up nearly a 3%. Take a look at the sector action. 10 of the 11 sectors holding on to gains. The only sector in the red is consumer discretionary. Energy, though, by far the leader today, up just around 2.5%. Taking a look inside the energy sector at some of the biggest outperformers here. You have Exxon up just over 2%. Chevron, the two large oil giants there, moving to the upside, and certainly a lot of green on the screen, Jared.
That's right, and it's a start of a pivotal week for markets as investors await a likely 50 basis point rate hike from the Federal Reserve. And let's take another look at the Wi-Fi Interactive. We did finally get that Nick Timiraos article today from the Wall Street Journal. He is, of course, affectionately known as the Fed Whisperer. And if we take a look at what bond markets are doing today, and I'll give you an idea of what he's talking about, and it's been more of the same. We don't see too much happening. A 10-year T-note yield that is up 4 basis points to 3.61%. The 5-year is up 4 basis points as well, and the 30-year that is up 2 basis points. But just to get on that Nick Timiraos article one more time, pretty interesting how he again makes the case that Powell is going to do whatever it takes to whip inflation, and that this next recession is not going to look much like the last one. Namely that when we do finally get indications of a recession, that's probably not going to be when the Fed pivots. So, Shauna, a lot to digest there. I know you've been keeping an eye on that as well.
Certainly is a lot to digest, a lot of hype ahead of the meeting that we are going to be getting later this week, that decision coming on Wednesday. And of course, we're going to have that for you on Yahoo Finance. But stocks still moving higher despite some of this uncertainty and the inflation print tomorrow and also the Fed meeting this week. And this comes as prices hover near a 40-year high. Treasury Secretary Janet Yellen weighing in on the current inflationary pressures and the odds of a recession on 60 Minutes. Let's take a listen to what she had to say.
It's critically important that inflation be brought under control and not become endemic to our economy, and we're making sure that that won't happen. There's a risk of recession, but it certainly isn't, in my view, something that is necessary to bring inflation down.
All right, let's talk about all this with Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeffrey, it's great to see you. So let's start with Treasury Secretary Janet Yellen's comments. She was pretty positive, saying that a recession isn't a sure thing. What do you think?
No, it's pretty assured, I think. In fact, if you take a look at a lot of the data, it is already pointing to probably we are already in maybe a mild recession. It's a little different than what we're used to, right? In 2020 and 2008 and 2009, they are what I'd call the everything everywhere all at once recessions. Everything was going down at the same time. It was obvious. And they began to rebound at the same time. This is very different. We're calling it a rolling recession. Right now, manufacturing is in a recession thanks to burgeoning inventories and slumping retail sales. But at the same time, the service sector is doing well. Just try and book an airline ticket or get a restaurant reservation. You can see that. So we're rolling through different parts of the economy in recession at different times. I think overall, economic growth is soft and pointing to at least a mild recession, and I think that's already in the cards. The question is, when does a recovery begin to form? And it's hard to see that happening before the Fed stops hiking interest rates.
And Jeff, we're still trying to figure out when the worst is over, I think, and maybe that's maybe some light can be shed on that tomorrow morning with that CPI print. Somewhat unusual that we're getting such a huge data print the day of an actual Fed meeting, at least when it's set to begin. And just thinking about that Nick Timiraos article that I was talking about that was released earlier today, How different should we expect this FOMC, and it has been different so far this year, but especially next year as we approach with the greater likelihood of a recession. And meanwhile, the Fed's trying to hit everybody on top of the head saying, look, our response is going to be very hawkish. You shouldn't expect surprises when we're telling you exactly what we're going to do ahead of time. At least that's the message I'm getting.
Yeah, well, here's, one of the things that happened earlier this year that really threw the Fed for a loop and certainly caused them to abandon transitory was that war in Ukraine by Russia. It certainly pushed up prices that were already elevated, pushed them up even further. It created a crisis, and they were forced to act to that, to aggressively tamp down inflation. I think the maybe unanticipated event, or the event that they're maybe not focused on, is the fact that while they're trying to step down interest rate hikes, China is stepping up their reopening. Remember, this is 1.4 billion consumers, the largest middle class in the world. They have pent up demand. Their cash flow, their deposits are high. Their mortgage rates have been falling, the opposite of everywhere else. That pent up demand could be unleashed in the coming, not just months, but maybe weeks. And we could start to see goods prices and commodity prices begin to rebound. Oil's up 3% today. Could that lead to a resurgence in some of the inflation pressures that the Fed wants to avoid? That could be the dominant factor as we look out to the next few Fed meetings, much more so than our own CPI.
Jeffrey, when it comes to what the Fed is going to accept, Mohamed El-Erian, he had an op-ed in the Financial Times today talking about that the Fed might stick with this 2% inflation target, but in fact, they're going to settle for something higher. Do you think the Fed will be comfortable settling for 3-4%, potentially even higher than that?
Well, the Fed has been consistent in its view that around 3% is a threshold for long-term inflation expectations it's uncomfortable with. So if consumer expectations remain anchored between 2 or 3, even if they're at the high end towards 3, I think they can be comfortable with CPI being higher than that as it maybe trends lower over a longer period of time. I don't think they have to hit that 2% or even get close to it by the end of the year, but they do need to keep those longer-term inflation expectations anchored. We did see that in the recent University of Michigan numbers. They're right at that 3% threshold. They don't want to see those go any higher. I think that's the bigger factor. The Fed has always talked about those expectations being more important than the current rate of inflation.
And how are you seeing this translate maybe into opportunities for investors? Where would you put your money right now or recommend that to clients?
So I'm really excited with what I'm seeing outside the U.S. In fact, Europe has seen the best quarter of stock market performance ever in the entire history of the Eurozone. This fourth quarter here, 25% gain, the best we've ever seen. And we're seeing in Europe more of the stocks that are outperforming in the US, meaning those with higher dividend yields and lower price to free cash flow ratios. I call those quality stocks. There are more of those represented in those European benchmarks, and they're doing so well. I'd also focus on the fact that what we're seeing in international markets is lower valuations, better earnings growth prospects for next year. All of this combining, I think, to create an environment where we'll see another year of international stock market outperformance. Despite the rise in the dollar this year, international stocks outperformed. I think we're at a turning point for this coming cycle of international outperformance. So I would focus there, an area of portfolios where many investors have neglected over the last decade, given U.S. leadership. That could be changing.
Certainly sounds like you're seeing a lot of opportunity overseas, but bringing it back here to the U.S., I know you like international versus domestic, but are you seeing any investment opportunity when it comes to the U.S.?
Yeah, so focusing again on high dividend payers, this is an area where even within sectors you don't normally think of looking for dividends. In the tech sector, we're seeing the best dividend payers, the highest dividend payers, outperform the rest of the sector by a wide margin. That's true really across the board in every sector, in every country. And that's a theme I think that may continue here as we see companies, yes, we're in a recession, but it's not one that's likely to dramatically weaken the cash positions of companies, which have really built up over recent years. So I think they'll sustain those dividends. That'll be something investors continue to focus on. So I think you don't need to think about sectors from an investment perspective. Think about characteristics or factors like high dividend yields and focus your investments on those.
And maybe strong balance sheets as well. Just to go show there are still some winners, potential winners inside the U.S. markets here. Jeffrey Kleintop, thank you as always. And we're just getting started here on Yahoo Finance Live. Coming up, Carvana is Yahoo Finance's worst company of the year. Stock tumbling from over $230 a share at the start of 2022 to roughly $5 today. We're going to tell you what happened Also, Salesforce's chief medical officer tells us all the ways telehealth is playing a larger role in healthcare since the start of the pandemic. And Oracle releases its second quarter earnings after the bell. We're going to bring you the numbers as soon as they break. Don't go anywhere. Welcome back. As we announced last week, Costco is Yahoo Finance's best company of the year. But what about our worst company of the year? To discuss, we're joined by senior columnist Rick Newman and senior autos reporter Praz Subramanian. I guess the beans have been spilled here, so I can just let it out of the bag. Actually, I'm going to let you tell everyone.
They want to know.
Yeah, the worst company of the year is Carvana. Just look at the numbers with Carvana. I mean, the stock is down, I think, 97%. It's lost about the same amount in terms of value. There are some questions about whether it's going to have enough liquidity to keep going. Speculation about a possible Chapter 11 filing some point in 2023. And the interesting thing about Carvana, guys, is it's actually a pretty cool concept. It's not like...
We've seen the vending machines. And,
yeah, I mean, it's not like this is a terrible idea. I mean, it's actually a really good idea. Find a better way to sell people used cars because just about everybody hates going to a used car dealership, and this... they're trying to be, sort of like the Airbnb or the Uber of used car buying. So they just got it over their skis in 2022. They did not cut back when they should have. They did not see the turn in the market coming as interest rates went up. And then they made a big acquisition that they took on a lot of debt to do, and that just has created cash flow problems for them. So they're trying to work their way out of it. They did say to us, look, a lot of disruptive companies have struggled in their early years and then gone on to become market leaders, and they say that's what we intend to do. We'll find out in 2023.
We'll see how they're going to get there. Praz, what do you make of this just in terms of the challenges that Carvana is presented with? A lot of them, you could argue, clearly self-inflicted. Rick just talking about that $2 billion acquisition that they made not too long ago. But what did we learn just about the online car buying model? Is that something that we should be worried about here for the future? Because it does make things a lot simpler.
Yeah, I mean, it is a popular service. I think Progressive did a survey, and they said 80% nearly of people said they had a highly pleasant experience buying a car online. And I think that it works for people that are Gen Z, Gen Y, people who are used to working online. I know women in particular like not dealing with car salesmen and going to the dealership. It's a hassle. And people don't like to haggle with the dealer. So it makes sense as a model, as an easy thing to do. In the pandemic, it made a huge amount of sense there. Get the car online, it comes to you. You don't have to go anywhere. You don't have to take public transportation. But as we know, this costs a lot of money. Costs money to recondition cars, costs money to acquire them and then actually deliver them. So the question is, does this model work? And I think for some companies like AutoNation and CarMax, it does, because they have their physical property to do servicing and also sales there too. So maybe it's a hybrid model, but like online only, I think it could work, but right now it's not working.
So one of the things that we talked about, that acquisition, that $2 billion acquisition, that was an existing auction company that has physical locations. So they did buy some real estate that they could have that they are using for vehicle reconditioning and things like that. The timing was just bad.
And they used debt. They got over 10% bonds for this. It was like insane when they could have sold their stock that was so highly priced.
So then what is the best case scenario then for Carvana, looking out to the future in terms of what analysts think should be or will be done to maybe hopefully turn this company around?
So it needs to solve its cash flow problem, which means get costs under control. However you have to do that. And some of the analysts pointed out to me, there are a lot of things you can do to get cash here, cash there. One thing that has not happened yet is one of the founders, which Eddie Garcia II, who's the father rather than the son, Eddie III. He has not apparently put any additional money of his own in, which he could possibly do. So there are ways for Carvana to get through without declaring bankruptcy or having to go through a restructuring that severe. They just need to get the cash flow under control, and it probably would help a lot too if we just got back to a normal car selling cycle and without interest rates suddenly.
Let me ask you about that.
Out of business.
In real estate, we saw Zillow in the early stage of the pandemic have some trouble with its proprietary model where it was buying houses and then flipping them itself. So taking on, a huge part of that consumer cycle. I see this as kind of a very similar situation with Carvana. They were taking on a larger piece of the pie here, but maybe the numbers were inflated because it was a pandemic and people didn't care about the buying price and the selling price so much.
I spoke to a local guy in Jersey who actually had a dealer that bought and sold cars, said that Carvana was paying $5,000 to $10,000 more per car than he was offering.
There you go.
And then it finally flipped over, and now they're going way below Manheim and all the other kind of price aggregators.
So an analyst will tell you that this company only thinks about growth. So this was a high-flying growth stock that did fly high when things were going well. And we all know the model, which is you spend as much money as you can to get as much market share as you can. I mean, look at Tesla. It took Tesla 15 years after it went public to actually turn its first annual profit. And Carvana was just going along spending money, and they just got into more trouble at this point than some growth companies do. But we also know that some growth companies flame out because they just go too far too fast. Yeah. And whatever happens, the market turns or the idea doesn't pan out or something like that, and it turns out that old-fashioned corporate fiscal discipline might have been appropriate instead of just go as fast as you can on every front.
And they certainly did. They went on a very large spending spree, to say the least.
I hope they make it.
I hope they make it too. It's a smart idea, and it makes a lot of sense. I hated going into the dealership and buying a car. I much rather would have done it online. Maybe I should have done it on Carvana. All right, Rick Newman, Frost Supermanian, thanks so much for your coverage of Yahoo Finance's worst company of the year. And of course, we have a number of articles on that coverage from Frost and from Rick on yahoofinance.com. Well, coming up, speaking of pandemic winners that clearly ran out of steam, Weber shares surging today on a deal to take the company private. That comes after massive losses year to date. We'll break down those details when we come back. Weber shares soaring this afternoon, up just about 23% on news that BDT Capital Partners will be taking the company private. Weber agreeing to this. Now, this deal values Weber at $3.7 billion. BDT's agreed upon price of $8.05 a share. You can see we're trading at $8.01. And Jared, we were just talking about pandemic winners, companies that didn't necessarily make the proper adjustments. We were talking about Yahoo Finance's worst company of the year, Carvana. I think you can make that case for Weber too. Yes, they have only been public for a short amount of time, going public in 2021, but they certainly did not make the adjustments needed. A lot of pent-up demand for their grills throughout the pandemic. Here we are on the other side.
Yes.
They're clearly not seeing this, and I think people would have been a little bit of an easy prediction going back just about a year ago.
Well, yeah, I think you could go back to 2021 and look at anybody who was marching into the New York Stock Exchange or listing on the Nasdaq that day and say, you're probably going to have a very difficult time next year. By the way, the end of this 14-year growth cycle that's based on basically free money is coming to an end, and you might have to rethink your entire business model. Do you think you can do that? And of course, they're going to say, yeah. Now, I was at the New York Stock Exchange when they came to market last year and listed, and there was that huge red grill outside. I think it was real. I'm not sure. It
looks awesome.
Must have weighed a ton, so they still got some swag from that.
It's a lot of meat too, it looks like.
This is a company that their IPO price was $14 a share, and now they're going to go private at what, $8 or $9 a share? That shows you something has changed in the market, and I think it's going to take a lot of these companies a while to reflect the new fundamentals, Shauna.
Yeah, certainly. There was also another grill maker, Traeger, that went public in 2021, in July of 2021. That stock moving higher today on this news of Weber, but still a similar story. That stock off 84% when you take a look at that max chart. Revenue essentially doubling from 2019 to 2021, a significant fall off that we have seen in sales over the past year. And shareholders, I think, trying to come to terms with the new reality, the macroeconomic backdrop that we're facing right now, the risk of recession, the fact that a lot of people make the case that we already are in a recession and people simply aren't spending. So to your point, a number of companies that went public over the last year are facing a very, very challenging, at least a couple of months.
Put it I have nothing to add to that. Very well said to that. And we want to stick with energy. I think we can do that. It's a very vague segue here. Gasoline prices continue to decline across the nation, falling for a fifth consecutive week. The national gas price average currently stands at $3.26 a gallon. And for more in the energy sector, let's bring in Bill Baruch, Blue Line Futures President. And Bill, always good to see you here. We can get into the nitty-gritty weeds of the futures market in a little bit. But first, your comment on these declining gas prices, which we kind of saw up until now and also coming off the election, but they're here and they are resonating in the public's mind.
You're right. I mean, there's been a bit more tepid demand than the market was really prepared for. We've seen this price action come down into $2 in the gasoline futures and retest that level when it was Omicron breaking in November, Thanksgiving of last year. So this is a pretty big level. I think there's a lot of support down here, and we're actually getting excited at this. But you look at jet fuel inventory levels, sort of in line with historical averages. That's something, relative to all the travel you're seeing, the numbers there, it's showing more alludes to tepid demand. Crack spreads have come in. And then, also, I think overall, there's a lot of sentiment taking this further as some liquidation comes into the market when it hits some levels.
So, Bill, I guess it sounds like this is presenting a pretty good buying opportunity, at least from your perspective.
Yeah, we've looked at it as a buying opportunity. I was joking around in interviews I've done in recent weeks and months that I've probably done as little in the energy space as I have done in the last, probably my whole career. I have sort of just being patient, and patience was really going to bring opportunity. And now we're seeing crude oil WTI contract get to $70. There's a lot of support down there on a technical basis, but also on a psychological basis. You don't want to see it break and close below 70, but so futures portfolios that we're trading very actively. I'm getting long in some call spreads in the February contract. 77.5, $81 call spreads. They're under $1. I think there's a pretty good upside there on a good rebound. We're also buying IXIC in securities portfolios. I think there's really tremendous value. It's a great trading vehicle we've used for much of the year.
I wanted to ask you, but there had been a bit of a discrepancy between XLE, that's the S&P 500 energy sector, the way that was trading and the way crude oil was trading. And not that they're always supposed to be in lockstep, but energy stocks finally came down a bit to meet crude oil prices, which has declined. And then taking your thesis that energy prices, at least WTI above $70, is constructively bullish. Anything besides Oxy? Are you liking the sector as a whole? What other energy stocks would you be thinking about buying here?
Yeah, we're very bullish in the sector as a whole. We've had between 15 and 20% exposure in the energy stocks in those portfolios this year. We dialed back in a couple recent weeks. Kind of fearful on the crack spreads. So Phillips 66 is one that we had stepped out of, kind of rolling back in. I think a little more of a high beta play in Oxy here. But historical averages, if you look at the relative XLE relative to crude oil, I mean, it was beaten down over the past really 18 months. And this is a rebound back towards the more historical mean. So I think this is something to keep in mind. Overall, broadly, crude oil is an area, $50 to $70. I'd like to just broadly think as, vicious volatility can happen in between it, but there's good bull markets while out above 70, 80 area that can anchor, but vicious, volatility between that and then bear markets below that $50 benchmark. So I think right now, if we hold 70, I remain very upbeat, but again, it's a very underinvested space, and these companies, they have tremendous free cash flow yields, like Oxy, 12, 13%. I mean, Exxon, 10%, Pioneer right around, I think 10%. And then, a lot of these companies, the cash flow is terrific. They've gotten themselves and their balance sheets into a really great spot here the foreseeable future, given especially an underinvested industry. I remain very bullish.
Bill, what about the biggest drivers of the price action that we've seen recently? Because I think a lot of traders heading into the month of December thought it was going to be a tough month when it comes to oil because of the Russian sanctions on Russian oil, that were going into effect this month. But it simply looks like demand seems to be the number one driving factor. Is that true?
Yeah, I think the demand is, like I said, a little weaker than one would expect. And you're seeing that with some of the crack spread movement, There's a bunch of different indicators that are out there. But I think broadly speaking, the headwind has been the SPR release. And I think that's going to become a more bullish factor as you look into next year. The other factor, too, I think, again, this is a market, the underlying crude oil prices, these global growth fears that really became very relevant last week. And they've been relevant for weeks prior as well. But I think last week, really kind of started to get that people scared. It just kind of a lot of the headlines. So I think a lot of liquidation, really took place. But the other side of that is the China reopening. And it's not something that's going to happen all at once. Something that's going to happen sort of slowly, marginally through the first quarter of next year. And I think there's a lot of longs in the space that were sort of leaning on this China reopening. And the fact that we couldn't get out above $83 technical resistance, I think just led to a lot of liquidation through last week. And then if you were patient enough and you weren't caught up in that windfall of price action, then the opportunity is here for you.
All right, real quick here. SPR refilling the Strategic Petroleum Reserve at $70 per barrel. Is that a floor? Is that something big? At least in my mind, I haven't heard of a floor in terms of U.S. crude prices in some time. What does this mean to you?
We haven't heard a lot of jawboning in recent sessions, but you go back a couple weeks, OPEC Plus was clearly looking at $70 in WTI as an area of to lean against and jawbone, $80 in Brent, roughly speaking, as an area that we would hear some jargon coming from. And if we don't see an uptick in global growth, we're likely to see potentially more production withheld in the coming meetings. I think that's going to be a bullish factor. There's a bit of keep away that I think that was being played because the White House said they were looking for $70 or below $70 to start replenishing that SPR. So I think a good response off the $70 level here today. There's definitely, I think, a great trade, but the incoming news, CPI tomorrow is going to be a big one. Yeah. And the Fed and the narrative that we get from the Fed and the rate hikes to come here through what would be a rate hike on Wednesday, as well as coming in February. I think it's going to just be a good pulse on the risk environment. You're going to need to keep a pulse on the risk environment in order to really kind of trade this market and navigate. But for now, it's a really good response off $70. I think there's room to run. But again, it's going to be a very volatile week.
All right, got to leave it there. Bill Baruch, thank you as always. And coming up, Amgen is making this year's biggest healthcare acquisition. We're going to tell you who they're buying up next.
Time for our triple play. 3 stocks that we are watching in the final 30 minutes of trading. We have Horizon Therapeutics, Coinbase, and DraftKings. My play today, Amgen buying Horizon Therapeutics for nearly $28 billion, its biggest buyout ever. Now the move pushing Amgen further into immune therapies, giving it a chance to build its portfolio of treatments at a time when many of its top drugs face the loss of patent protection in the coming years. Amgen paying $116.50 a share for Horizon Therapeutics. Jared, this was actually the largest healthcare merger of the year. So ending the year on a positive note, if we could say that, one of the big M&A deals today. So I guess a bit of optimism here as we close out what has been a very, very tough year for the markets and for a lot of healthcare companies.
I'll tell you what, I don't comment on the fundamentals of these biotech deals because most of the time I can't even pronounce the names of the drugs or studies involved. I will comment on this chart. So Horizon Therapeutics over the last 3 months up 68%, and a lot of that premium being built in today. I'll just show you a chart over the last 3 years. You can see it's been kind of a whirlwind. So it was up quite a bit into the end of 2021 and then reached their low in the middle of 2022 and have come off quite markedly from that low. So could be a decent buy here for Amgen. Again, not commenting on the fundamentals of that deal. Although I will comment on the fundamentals of Coinbase, which is my triple play, sinking below $40 per share to a record low today after KeyBank initiated coverage with a sector weight recommendation. The firm noting that Coinbase has a highly scalable model, but lacks visibility on revenue growth, though the growing contribution from subscription and services revenue does add balance. So let me pull up our Wi-Fi Interactive here. Coinbase up 5% today on a year-to-date basis. Josh, still, as I mentioned, it is at not only the bottom end of its range, but it actually reached a new all-time low only today. So basically took out this months of basing here, kind of negated it, and not looking that positive for traders, Josh.
And one thing that's fascinating with that chart to me, Jared, is you look at Coinbase, they're down about 80% this year, and then you go to Bitcoin, which Coinbase you would think trades with in some relation, right?
Yes.
And Bitcoin's actually only down about 65%. And I think that's interesting just when you think about Coinbase and how attached that model is to crypto, right? How you're going to probably need crypto prices to come back up in order to drive more volume and more trading there and get more revenue for Coinbase. And we don't really see a lot of trends right now in the crypto space that mean more people are going to want to get in, right? If anything, it seems like those volumes are going down.
It's going to happen when the crypto winter ends, which means volumes pick back up. This is a business highly levered to the crypto prices, and nothing's going to change that in the short term.
Feels a little cold out there right now. My play today is going to be DraftKings. Shares up marginally today, about 1.5%. But really why I'm watching this stock today, guys, is off a new note from Ed Engel at Roth Capital Partners. Now, Engel reiterated his $15 price target, but he downgraded the stock from buy to neutral, citing Fanatics' anticipated launch of an online sportsbook in the first quarter of 2023, writing that the launch can, quote, disrupt the profitability narrative for DraftKings. Fanatics has been valued at $31 billion and most recently raised $700 million in November, Shauna, that they're planning to add and sort of go with the sportsbook with that $700 million. And what I think is interesting that he also pointed out here with the profitability for DraftKings. DraftKings is projecting profitability in Q4 of 2024. You look at the other names in that space, MGM, Caesars, Penn, FanDuel thinks they might get full year profitability next year. When Fanatics comes in and starts promoting, it's like someone putting something on sale. DraftKings is going to have to put something on sale to sell too. You're going to see more promotions come back into this space. Does that profitability mark get pushed out even further? And if it gets pushed out even further, I think some of these investors are going to start to get disappointed because that line keeps moving further and further out.
Yeah, and that certainly seems to be the case that more and more analysts on the street are making here in recent weeks. JP Morgan also recently downgrading DraftKings just about 2 weeks ago. A little bit, I guess, concerned just about the outlook of the company, what exactly we'll see in terms of results over the next couple of quarters. My question, though, is the upside potential of a lot of these sports betting companies in terms of the near term, because a lot of that, I think you can make the argument that that's already been priced in, and the next couple of quarters is going to be pretty uncertain until we see much larger adoption, and I'm not so sure as to what's going to be driving that right now.
And I think part of that too is the market share, right? When we talk about more adoption, you're going to see more legalization next year. We know a big state like Massachusetts is coming online. Ohio's opening up more. But I think it's also the market share where DraftKings is positioned well. We know that. They're second in market share. They're just not necessarily making money off a lot of those customers, but it takes about 3 years for those states to turn profitable usually, and we are building that base up, right? When we think about some of the states that opened up this year, that 3 years is coming sooner and sooner for some of them.
So you just have to have a longer term outlook if you're betting on some of these names. All right, well, coming up next, the COVID pandemic has made some permanent changes to the healthcare industry. Salesforce's chief medical officer tells us about them and what you need to know. Next. Investors taking a bite out of shares of Cheesecake, although now you can see trending higher, so shaking off those earlier losses that we saw following a downgrade from Goldman Sachs. Now the company getting a little bit more bearish on the name, hitting the stock with a sell rating and a $29 price target on shares of Cake, C-A-K-E. Now, analyst Jared Garber making the argument that he's seeing declining traffic to restaurants amid a, quote, volatile macro backdrop as a key concern heading into 2023. Jared, consumers beginning to pull back on spending when there really is no easing up of inflation, at least in sight right now. The Fed remains committed to its rate hikes. I think that's spooking investor sentiment and certainly consumer spending trends. And this analyst here from Goldman saying that inflation, labor costs are the two main issues facing Cheesecake Factory right now, and more difficult to pass through menu price increases he sees on the horizon for the new year.
It's all about the margins, right? We have a very difficult labor environment. We have a very difficult pricing environment. And as you said, the Fed the Fed is its own animal. So we're not even bringing the Fed into this. But this situation is probably going to last several more quarters. Not going to see any change in this. And I just want to quote from the ratings downgrade paragraph here in the Goldman note. We see risk that traffic declines accelerate with high levels of pricing, and the mid to higher income consumer expected to see the lowest year-over-year discretionary cash flow growth in 2023, while our proprietary survey data that suggests these consumers seek to spend less given the volatile macro backdrop, high inflation and wealth effects. So kind of a worst of both cases there. I think this is continuing to be a bifurcated space. It's going to be one of execution, and it's not just a restaurant industry. You're going to have winners and you're going to have losers. investors. You're going to have those companies which are able to take advantage of the new environment or at least not be harmed by it, and others that won't. And this is simply a story of have and have-nots, I think.
Yeah, certainly. And we just had the year-to-date price action on the stock so far since January 1st. And if you look at that, year-to-date, it's off just about 14%. So more broadly speaking, in line with the broader market. So I think it's been able to weather the downturn that we've seen in recent months a lot better than some of its peers, at least.
Yes. And with the rise of telehealth and in-pharmacy vaccinations, the COVID-19 pandemic may have changed healthcare forever. Yahoo Finance's health reporter Anjali Kemlani is here with more on this, and she is joined by Geeta Nayar, Salesforce Chief Medical Officer. Anjali, take it away.
Thank you, Jared, and welcome to the show, Geeta. Really great to have you on. Obviously, as Jared mentioned, looking at what the pandemic did for healthcare, we know that telehealth was the first sort of upheaval, but retail health really is an interesting point. We've seen CVS, Walgreens, Walmart, just to name a few, some of these players really getting bigger in the space of providing healthcare. And that introductory touch point may have been getting vaccines during the pandemic. So I want to start off there and just ask you, what do you think going into 2023 we can expect as sort of the tail end of the COVID impact of this?
Well, Anjali, first, thanks so much for having me on. And what I would say is that it's just the beginning. There has been nothing but a land grab, as you just mentioned, some of those big logos in the retail health space. And the genie cannot be put back in the bottle. Consumers are finding that everyday convenience converging with healthcare, and healthcare has been everything but convenient, both during the pandemic and before it. So it's really blending that everyday convenience with that blood pressure check, with that glucose check, and with that pharmacist, that trusted pharmacist in the community that you can walk in anytime and ask that question, as we've just lived through a really tough era of misinformation. So consumers are looking for that trusted community, that trusted place, and retailers are looking to build off of that convergence, but still sell that face cream. So while they're selling healthcare services, it really is about broadening their market share in retail.
And I wanted to touch on the sentiment of that, because as you pointed out, the trusting part, I think prior to the pandemic, we saw a lot of upturned noses, if you will, at the minute clinics and the like. And it seems like, based on a recent New England Journal of Medicine article, they saw a survey which showed that there seems to be increased positive sentiment for retail health. As you can see on your screen, 66% improved view of retail health, and 71% see it still as lower quality than primary care. So there's a shift. There has been some view of it as lower quality than providers, the normal doctor visit, and the global sentiment seems to be a little bit more positive than the U.S. sentiment on it. So talk to me about that and how that really fares for the market for some of these major players.
Sure. So look, the retail environment is really the place you want to go to for your low acuity healthcare. So what do I mean by that? I'm a rheumatologist. I see lupus patients, rheumatoid arthritis patients. These are complicated chronic diseases. The retail health environment is not for those patients. It is, however, for that earache, that upper respiratory infection, that vaccine, that blood pressure check. So the really low acuity healthcare visit, and that everyday convenience can't be beaten, right? I would much rather have a consumer go into their local retailer, get their blood pressure checked, rather than ending up in the emergency room with a heart attack. So it is about the right place and the right time, but there is no doubt that the physical proximity of retailers helps enormously. About 90% of the population is within 10 miles of a Walmart. We simply cannot say that about primary care clinics. So while the quality of a provider visit might be higher, if it's not accessible and it's not convenient, patients aren't going there. And they're certainly not coming back, even if they went once. So it is really about that customer loyalty and the retail market being built for customer loyalty, and the healthcare market simply is not.
How does telehealth fare in all of that? Do we still see a continuation of the momentum we saw last year?
So telehealth remains now a staple part of any visit. Consumers have found that it's more convenient. Providers are seeing that they are able to integrate the right kind of visit for virtual care, But as my husband says, who's a bladder surgeon, bladder surgery still has to be done in the hospital. So you've got to, and I say not yet, maybe from the living room soon, right? So we're still learning as a healthcare industry, but the consumer has accepted telehealth as part of their everyday interaction with the healthcare system, and the convenience of doing it from your home, doing it from your office, or wherever you need it is, again, unbeatable to when we think about the traditional way healthcare has been delivered in the past.
Speaking of that traditional way, let's talk about the providers, because that's a really key piece of this equation. How are they feeling about this shift in consumer sentiment, especially as more and more patients are being viewed as consumers?
Well, the heat is on, Anjali. The heat is on, and providers that are smart are also investing in virtual care, virtual health technologies, and they're looking to partner. If you think about a long-tail retail strategy or a long-term provider strategy, partnering with some of these retailers is really important. I mean, look at Best Buy and what Best Buy has done with their connected devices. They want to connect that back to the provider so the provider has a better 360 view of their patient. I'm all for it. The consumer is all for it. And we are living in a world that is really pushing the paradigm forward in healthcare. Consumers are saying, if it's not convenient, if it's not accessible, I'm simply not going to go to the doctor's office.
Yeah, that's a really good point you brought up about Best Buy. Who knew we would be talking about that with relation to healthcare? Geeta Nair, Chief Medical Officer of Salesforce, thank you so much again for joining us today.
And thank you for that, Yahoo Finance's Anjali Kimlani. Coming up, Wall Street is heading towards another down week. Find out which stocks are making the biggest moves ahead of the close when we come back. All right, let's take a look at some of the stocks moving ahead of the close. And we're leading with some news involving CVS and Walgreens. Both are up a little bit less than 2%. I'm going to put a one-year chart as I read you the news here. They've settled with various state attorneys general for $10.7 billion over their roles in the opioid crisis, of which CVS will pay $5 billion over 10 years and Walgreens will pay $5.7 billion over 15 years. Both pharmacies agreed to court-ordered relief, requiring them to monitor, report, and share data about suspicious activity related to opioid prescriptions. And now moving along to the software space, I'm going to bring that up here. One of the little smaller names I should point out is Coupa Software. They are up 26% today, and that little dot right there is where they are in relation to their one-year chart. And this is fueling Coupa's software rise to the top of Yahoo Finance's charts, trending tickers today. The accounting software company handily beat on both its top and bottom lines, but the big story is that the company may not be preparing too many more 10Qs if the Thoma Bravo private bid for the company to the tune of $6.2 billion goes through as planned in the first half of 2022. Of the private equity deal to be paid in cash, Citigroup is saying Coupa ran a deliberate process with both strategic and financial parties before agreeing to the offer, suggesting limited risk of another betting offer coming in later. Also, Citigroup adding $81 per share that takeout may be lower than some shareholders wanted. And now to another partnership, this one involving the exchange space and a familiar name, Microsoft, one of our giant trending tickers here. And let me just put this in. And also the London Stock Exchange. Now, we don't talk about the LSE too much, but the news today is they may be giving into a Bloomberg competitor. It may be giving up some of those rights. A terminal run. Now, that's kind of a pun on the Bloomberg business line. You can see London Stock Exchange, that is up 13% year over year. Now, the exchange is selling a 4% stake to Microsoft valued at $2 billion, and it will be licensing its data in the platform capabilities to the tech giant. These include those from the LSE's $27 billion purchase of Refinitiv last year. Microsoft will be weaving the data into its 365 and Teams software, and it expects the deal to generate $5 billion over the next 10 years. So, Shauna, not a lot of news, or I guess second day news on this today. We kind of got the story overnight there, but I will say it's kind of a big deal. You think about Bloomberg competitors, maybe Microsoft and Refinitiv through London Stock Exchange have the ante here.
Yeah, you know what's also interesting, just from a regulatory perspective as well, right? Kind of this blurring line between big tech and banks and exchanges in this case. And it's not something that we haven't seen before, because last year, Google, CME had a partnership. They reached a partnership. Nasdaq and Amazon reached a partnership. But from a regulatory perspective, I would think that a deal like this would likely be scrutinized, given the fact that now we're seeing kind of those boundaries being blurred just a bit.
We'll have to see. We know big tech has been in the forefront here, especially in antitrust regulators, headlights here. But I don't know that exchange data, especially through this Refinitiv purchase, when Microsoft really doesn't have a direct line of business into that kind of line of business. I don't know if the regulators are going to get involved, but they're always up Microsoft's case.
Or the fact that they're relying on just only a few cloud providers out there. But it's going to be interesting, but certainly a deal to note today. All right, well, we are counting down to the closing bell on Wall Street. Once again, still looking at gains. The Dow now up 510 points. We'll be right back. Just under a minute here until the closing bell. We're right around the highs of the session. The Dow now up 521 points. You can see the intraday chart here on your screen. The S&P up just nearly 1.5%, getting closer and closer to that very important psychological 4,000 level. Also, Nasdaq 100 up well over 1% right now. Taking a look at the sector action. Once again, most of the sectors moving to the upside. Consumer discretionary now actually in positive territory. All 11 of the S&P sectors in the green this afternoon. Energy by far the leader. Taking a look inside the Dow, 29 of the 30 Dow stocks trading to the upside. Amgen, the only stock in the red. And here's your closing bell.
All right, and stocks ending the day in the green. We got the Dow 1.58 percentage points, S&P 500 up 1.43%, and the Nasdaq, we'll call it a laggard, they're up 1.26%, but everything still strongly in the green. We're taking a look at that inflation data looming tomorrow and a pending Fed decision this week. Where do the markets go from here? For a closer look, we're going to bring in U.S. Bank Senior Vice President Lisa Erickson and Acorn's Chief Investment Officer Seth Wunder. Seth, let me pose this to you first. In terms of that inflation reading we're supposed to get tomorrow, and then how are you viewing the potentiality, especially with respect to the fact that the Fed will get to consider that as well in its 2 days decision, policy-making decision, which they announce on Wednesday?
Yeah, I mean, the broader inputs to inflation are slowing quite considerably. I mean, if you look at unleaded gasoline across the country, it's actually flat since the beginning of the year, and oil year to date is now down. Whether that shows up in any one data point in government metrics and so forth will be a little harder to predict exactly. But I mean, you saw the Fed governors earlier in the month talk about a slowing rate of increases and so forth. I mean, they understand that the economy is slowing quite precipitously. So the trend is a slowing of inflation for sure. Tomorrow's data point, we'll see give and take.
Lisa, what do you think? Do you agree?
We do expect inflation to continue to come down. It may have some fits and starts to it, but what we see overall in the data is both on the goods and services side of the economy, some slowing. So I think really the key question is not necessarily the direction, but the magnitude and the speed at which inflation continues to come down. That's really the big question for the markets. Obviously, we got some very positive sentiment today as we saw some of those inflation expectations from the New York Fed continue to come down. But the central bank is wanting to see that continue to come through in the data. So it'll be great if we do get a letdown in the pace of inflation in tomorrow's CPI point, but we're going to want to continue again to watch how quickly that continues to evolve through the year.
Hey, Lisa, Pross here. Just want to follow up on your question there. Tomorrow, big print tomorrow, CPI, also the Fed meeting starting tomorrow. I'm kind of curious today. We saw a big move in stocks, but also the volatility sort of picking up too. I had a big move in the VIX. What do you think? What do you think's behind that exactly?
Well, investors are trying to be more positive, as we've seen over the last few weeks, but there is a lot of uncertainty over what the outcomes will be. Again, we've started to see some decline in the rate of inflation in various measures, but again, people are not sure how sustained that will be. And we did get a negative surprise from PPI last week on the input side of the price pressure. So I think what you're seeing with that jump in the VIX is, again, people are hoping that we're going to get some more positive news, but just the level of uncertainty is causing that volatility to rise.
And Seth, I want to ask you about this Nick Timiraos article that appeared in the Journal this morning, the also known as the Fed Whisperer, putting it out there quite plainly that even if we get a recession next year, the Fed's probably not going to pivot right away. I'm wondering how you square that with your notes to us in which you're saying that a Goldilocks scenario of sustained growth, modest rise of unemployment, and cooling inflation are still on the table. Are these just realms of potentialities here? What's your base case?
Well, I think those are actually quite consistent, right? So, as the economy cools, to the degree that it doesn't accelerate to the downside, we could actually have a jobs market that stays fairly robust. But the Fed, doesn't have to keep raising rates if inflation cools, and they also don't have to necessarily ease to the degree that the economic slowdown is modest. And that the employment picture doesn't alter all that dramatically. So, risk assets would adjust to that Goldilocks backdrop. The reality is I think what the Fed wants to do is probably pause through the first half of next year, assess where we're at, give time for these rate increases to continue to flow through, particularly in the housing market and consumer spending and so forth. And then we'll go from there. So I actually think that narrative of Fed pause and potential Goldilocks is a continuation of the same storyline.
Seth, when it comes to Fed policy, I guess, what do you think has already been priced into the market? It sounds like 50 basis points on Wednesday is the most likely scenario. That's what traders are mostly anticipating. But looking further out, how much of that has already been accounted for?
Oh, I think all of it. To the degree that the Fed gets themselves into a position where, I mean, maybe there's another 25 or 50 basis points behind that and it trickles over the first half of next year, I think that's pretty much in the market. I mean, if you look at like capital flows, where volatility was all this year and how people are invested and so forth, the sentiment has been horrific, except for the last, let's say 45 days. So whether it's forward curves and so forth, the market's discounted a lot. It's not dissimilar than if you go back to the early 80s. The reason why the market was up so dramatically after Volcker pivoted was because the fear factor of not having 2 points makes a line is sometimes stymieing to people. I wouldn't say it's as extreme today, but it's certainly you see it across the board. So to the degree that we get ourselves into a predictable environment of where rates can normalize here, I think the market has overly discounted some of the worser case, more difficult scenarios.
Hey, Lisa, so if you think that, like Seth's saying, the rates kind of will normalize soon, what are you sort of looking at in terms of plays for investors at this point?
Well, right now we are uncertain again how quickly the Fed is going to pause and then pivot. So because of that, we are more cautious overall on more risk-on assets like U.S. equities. So we are really advising our clients to relatively emphasize bonds and things like real assets, both including listed real estate and listed global infrastructure. And the reason why is if you look at those various asset classes, they do have relatively high levels of income, and that can be really a nice buffer in a more volatile environment and an environment where stocks are certainly facing headwinds, again, just because of the tightening monetary policy.
All right, Lisa Erickson, Seth Wonder, always great to have you. Thanks so much for joining us this afternoon. Coming up, we've got Oracle earnings crossing the wires right now. Shares reacting to the numbers that we are seeing. You can see the stock up nearly 3%. More on that when we come back. There could be more layoffs coming to Wall Street, and Bloomberg reporting that Goldman Sachs could be cutting at least 400 jobs from its consumers business. Now, this comes as the big bank looks to restructure that division. Now, the report also stating that Goldman is, quote, turning off a checking account product that was in beta testing. And Pross, this comes after Goldman's headcount has really swelled over the last several years, up 34% since the end of 2018. 2022 has certainly been a very challenging time for the company. We've heard CEO David Solomon say numerous times over the last several months that it's been tough here for Goldman Sachs. It's going to continue to be tough given the macroeconomic backdrop right now, and that cuts could be necessary. So I don't think this is necessarily a huge surprise here to the street.
Especially with Wall Street, they're the ones that are sort of first to kind of trim the fat, if you will, when times are going to expected to come in a little bit tight. Their consumer bank was it's a tricky business. It's one that they've been trying to get into for a while. Remember, it was called Markets before, and they changed the name to that. And it's been, I guess, struggling with regards to acquiring, consumers there for those banking operations. One thing I'll note is that Solomon has not been shy about talking about wanting to trim the fat. Mm-hmm. I think he said in a conference last week that they're watching every operation, want to be nimble when they can be, and cut when they have to. So I'm not surprised that he's really thinking about doing that right now, especially in that consumer banking division.
Yeah, I think I don't know that Goldman Sachs really wanted to be in the consumer loan business to begin with. There was an article I was reading where you got these people in court chasing down people who had welched on loans. Well, small businesses are not the normal client base for Goldman Sachs, although they are the business engine of America. So I'm not surprised to see Goldman exiting a few of those bets. And, in the tech world, tech overhired to a huge degree, not the same degree that finance did, but and as much as finance wants to be fintech and wants to incorporate a lot of that into their business, I'm not surprised that they overhired as well. And so I think they're just coming kind of back to reality, to a more normal beat here. I wouldn't read too much into these layoffs as above and beyond the norm.
Yeah, certainly. And put 400 headcounts, not diminishing, or I guess, what should I say, not discounting this at all, but 400 headcounts in 400 jobs in relative to their total headcount is a very small portion of Goldman Sachs business. And it's also important to point out that this is in addition to Goldman Sachs annual trimming that they do every year of underperformers. So this additional Bloomberg report of 400 jobs being cut from the consumer division is in addition to what the big banks typically do, typical cuts at the end of each year.
Right.
Sorry, go ahead.
Good. I think we wrapped that up. I'm just going to go ahead and break out some new earnings numbers that we have from Oracle. Now, on the second quarter, and by the way, the stock is up about 1%, had been up as much as 3 or 4% after our trading. Second quarter results, adjusted revenue came in with a beat, $12.28 billion, up 18% year over year, best the Wall Street estimate of $12.02 billion. Now, in terms of some of the how that breaks out, cloud services and license support revenue, that was in line at $8.6 billion, up 14% year over year. Services revenue also in line with expectations, $1.39 billion, up 74% year over year. Here's where we saw some beats. Cloud license and on-premise license revenue, that's $1.44 billion, came in ahead of estimates of $1.3 billion. And then service hardware revenue of $850 million, that's up 74% year over year. And that is in line with actually that best the estimate of $767.1 million. A couple more numbers we've got to throw out there. Adjusted EPS, $1.21 versus $1.21 last year, but besting the estimates of $1.18. And adjusted operating margin, 41% versus 47% a year ago, and better than the Wall Street estimate of 41.6%. Just a quick commentary here. Without the impact of the U.S. dollar strengthening compared to foreign currencies, Oracle's reported Q2 non-GAAP earnings per share would have been 9 cents higher. So that U.S. dollar really weighing on some of those results there as well, Shauna.
All right, well, let's get more reaction here. We want to bring in Daniel Morgan, Synovus Trust, a senior portfolio manager. Dan, great to see you. So beat here
Hi, Shauna.
From Oracle on both the top and bottom lines. We're seeing the reaction in the stock in extended trading. But what's your initial take? I know you've only had a minute or two to dig into these results, but what do you think?
Well, what was very encouraging, Shauna, was the cloud revenue. That came in at $3.8 billion. That was up 18%. And we all think of Oracle as a company that's a dominant player in the relational database area. They have 42% market share, dominant in enterprise resource planning. But the big thing that the street wants to focus on is how are they growing their cloud business? And it looks like from the numbers that you just read, they beat on 2 of their major segments out of 3 in terms of expectations. So it looks like the transition for Oracle as being a dominant or a major player in the cloud space is still intact. And so overall, it looks like a great quarter.
Hey, Dan Prosser, do you think companies like Oracle involved in the services and cloud servicing sort of operations are better sort of situated right now compared to like your standard hardware tech companies?
Well, you know what's interesting about Oracle is they have over 400,000 customers. And of those 400,000 customers that use mostly their database, only about 35% of them have moved over to using their cloud service products. So there's just a tremendous opportunity for them to convert their existing base. Just about every shop has Oracle in it, and moving those over into services. We have to bear in mind they were late to the game. Larry Ellison was very late making the migration to cloud because it was a subscription-based model, and he was used to the old licensing maintenance model, and it was more profitable. But he's had to move forward, and they've done a great job in terms of adding new products. But if you look at, platform as a service, infrastructure as a service, and software as a service, they're still all kind of single-digit market share. So they have a lot of potential in terms of converting people over into their cloud products.
And Dan, I was honing in on that comment regarding the U.S. dollar, that adjusted EPS would have been 9 cents higher. That's from $1.21, so that's a significant percentage higher as well. Just in terms of Oracle and maybe any other companies that you follow in the space, how much of a headwind has the U.S. dollar been?
Yeah, FX headwinds were a big item as we closed down in the third quarter with a lot of our big software companies that we follow, Salesforce, Microsoft, and so forth. So that's a big number, 9 cents. That would have been even a bigger beat than what they had on the EPS line. So that obviously puts a negative effect on top of revenue growth for these software companies that do a lot of business overseas because of the strength of the dollar. And we saw that with Oracle. So I think that was kind of baked in, kind of built in to the report. But the 9 cents is a little bit more than what I was kind of anticipating. So that would have even made it go up even more, right? If we didn't have that FX headwind.
Dan, looking out though into 2023, how do you see Oracle holding up given the macroeconomic pressures that we know not only Oracle is facing, but every single competitor out there and across all industries?
Well, Oracle's in a unique position. I mean, they only traded about 15 times earnings, so their multiple is very low. You compare that to companies like Snowflake and other companies that are not profitable, they're in a much better position than they are. As I mentioned before, they have a huge installation base, so a lot of their revenue is reoccurring, so they generate a lot of cash flow. So I think what's kind of interesting, guys, is 2 years ago, we weren't talking about Oracle, right? We wanted to talk about companies in the software space that are growing 25, 30% a year, like Adobe. Now, all of a sudden, all that growth is kind of vanished, right? And they have that big customer base that they're able to harvest that revenue from. So now we're looking for consistency, right? And low multiple stocks that don't get hurt as much if they miss. And Oracle's beating, kind of like an IBM right now, or ADP or Citrix Systems. All those value plays in tech are doing very well. So I would expect Oracle going forward into 23 to be positioned very well compared to some of the high flyers in that space, 2 years ago that were going public with no earnings that no one's talking about anymore.
Hey, Dan, so Larry Ellison has some pretty positive words to say about Cerner. It's a new acquisition about healthcare tech company. Do you think you see more of these kind of buys from Ellison and crew coming up in 2023 and beyond?
Yeah, Larry Ellison is notorious for acquiring companies. I don't know how long you've followed Oracle. I've been following it for over 30 years. They bought PeopleSoft. They've bought some huge companies in different spaces to get a focus. And the movement towards Cerner was a good deal for them because it gives them access to the healthcare space. It allows them to use their cloud products and their efficiency and data management, all things they're really good at in making Cerner more efficient. So I would expect them to do extremely well with that deal. And Oracle and Larry Ellison has a tremendous history of acquiring large companies and pulling them under the hood and moving forward and doing very well with them. So that's going to be very accretive too on their top line in terms of revenue because you're putting $27 billion company on top of what they have now. So it's a good deal for Oracle.
Dan, we'll have to keep an eye on those deals for next year for Larry Ellison and crew. Thanks so much, Dan Morgan. Coming up, FTX's new CEO will be testifying in front of Congress tomorrow. We'll tell you what's going on with that. And A new survey reveals TikTok is only the third most used social media platform among Gen Zers. Find out which brand sits in the top spot when we come back.
Welcome back. Unacceptable management practices that, quote, expose customer funds to massive losses. That's what new FTX CEO John J. Ray III will tell Congress tomorrow at a hearing about the collapse of FTX. Let's bring in New York Times finance reporter Emily Flitter to discuss this and just an overview of what we can expect tomorrow. No SBF. We know that he's not going to appear there, but what should we expect?
Well, I think we're going to hear about the mismanagement of FTX's accounts and general corporate functioning. And what I think we should all be looking for is a sign that the books are telling the story that we're beginning to hear in reporting, including from my colleagues and myself at the Times, about just how intentionally mismanaged this company seems to have been.
Hey, Emily, what do you think about sort of the allegation in this Reuters report about how CZ told employees to use encrypted messaging, don't send emails, all those types of things? Does that look so very incriminating from your point of view and also from the DOJ's?
Well, CZ, the founder and CEO of Binance, which is an FTX rival, has definitely spent a lot of the existence of FTX trying to avoid regulatory scrutiny, and he has talked openly about that. It also seems to be of a piece of what the industry had been doing in the lead up to 2021 and even this year. I mean, basically all of the exchanges are being looked at for violating anti-money laundering rules. And the purpose of crypto was to, in large part, have a system of financial transfers that was free from government oversight. So that's not terribly surprising. I think we'll see what the Justice Department ends up telling the rest of the world when they finish these investigations, including the one into Binance.
And I have to ask you, with these hearings ongoing at the same time that we have actual bankruptcy court proceedings, what, if anything, are we likely to learn out of this process? And then what we take away from it, is that going to be something entirely different? I'm just wondering what you think the public can be gained out of this.
You know, this is unprecedented to a certain extent. I mean, we've had plenty of congressional hearings about companies blowing up, and but we're basically at a point where we're looking at an entire industry that is having a moment of reckoning. And it's not being shielded from sort of the consequences of its own actions, the way perhaps the traditional financial system has been shielded when its players do something wrong. By the time that you get to be as big and as integrated as a traditional financial company, when something goes wrong, the regulators and investigators and just everybody involved in the process are all aware that with the wrong words, with the wrong framing of something in a public statement, they could cause a panic that could really hurt other people in the industry. I think that what we're seeing with crypto is there really aren't any holds barred in this inquiry, because it, as my colleagues in the media have been pointing out, doesn't matter as much. It's not going to bring down other parts of the global financial system. So I really think it's going to be exciting to see how far the lawmakers push and what John J. Ray reveals. I think it's just going to be a really interesting thing that I'm going to watch like everybody else with great curiosity.
Emily Flitter, thank you so much.
Thank you so much for having me.
All right, well, we know crypto is an important, or I guess an interest here to many Gen Zers, but Morning Consult was out with a survey looking into Gen Z, some of their interests this time, particularly what they liked about their media taste and also their habits, their favorite celebrities, relationships with brands, and more. Let's start with one of the most surprising findings, and that's that Despicable Me franchise is among the favorite here in Gen Z. A third of the Gen Zers surveyed pros saw this in theaters. We know the importance of social media when it comes to Gen Z. A big reason why so many Gen Zers went and saw this movie in particular in theaters was because of a trending hashtag, Gentle Minions. That trend on TikTok got over 61 million views. And for those of you out there that don't know what it is, I did not know what it was, full disclosure, before reading this survey, but it was when people would film themselves dressed up in suits and sunglasses when they went into the theater. So that playing a significant role into why so many Gen Zers went and saw this movie, and the fact that it did pretty well at the box office.
Yeah, you know, I was looking at the age range for Gen Z, and I thought this is kind of young for them to be into Minions, but I guess this Gentle Minions trend is what they're really into. One thing that caught my eye was, of course, stuff like YouTube coverage or YouTube kind of usage. We saw that YouTube ad spending was down just a tad last quarter, and people were concerned about that. But I got to say, if Gen Z is so heavily involved with stuff like YouTube to the point that it's blowing away stuff like TikTok, I think it's a positive for Google, right? I mean, it has to be, in my opinion.
I had to look up this Minions bit too. So I can dress up in sunglasses and enter.
You basically go in what you're wearing right now, just throw on the sunglasses and you're perfect.
That's what I wanted to clarify, because I am a Despicable Me fan, but I didn't realize there were these super fans who had one up on me. So I'm
missed opportunity, Jay.
I know. I'm going to be reborn as a Gen Z. Is it too late for that? Maybe.
No. You can get in, you can do what the kids are doing these days. But Pras, to your point, YouTube being a top destination here for Gen Zers, I was so shocked that it blew away Instagram and, more importantly, TikTok and Snapchat. The fact that Snapchat and TikTok were essentially the same here, just in terms of the most used social platforms. It really speaks to the fact that if brands want to be successful, at least when it comes to Gen Z, they need an online presence, and they need to really be capitalizing on that, because that's where a lot of Gen Zers figure out what's coming out in terms of the media industry and why they are making the decisions that they are making when it comes to brands.
Can we put that back up, Gen Z's most used social platforms? Because I think when a lot of people think YouTube, they're not thinking Alphabet, Google. Google has a huge stranglehold in terms of YouTube that has not even been fully monetized yet. I just think there's incredible opportunities there.
Oh, I'm sorry to interrupt you. You know, one thing that kind of caught my eye was, you know, the Piper Sandler teen survey, Snapchat usually the top platform, right? So I'm kind of surprised to see that. Well, Instagram, not surprised, but YouTube and then TikTok actually below that. So that's a little bit surprising to me. But I'm not shocked that, you know, Gen Z people are into short form content, short form video. We see YouTube doing that now, pushing. I mean, I've seen my YouTube feed pushing a lot of short term videos. So I think that's where the industry's headed. And then why not? Because these are these young users you want to kind of court now, so you have those kind of buying habits or consuming habits going forward after that.
Yeah, that jumped out to me, something that I am totally on board with. They said Gen Zers, most of them wanted their TV episodes to be 45 minutes or less, their movies to be between 2 and 2.5 hours. To me, it makes a lot of sense. They value their time. They don't want to be sitting there for a long period of time. You know, I've always struggled.
What about a good night's
movies? And that maybe is one of the things that's kept me from the movie theaters
All right.
for so long. So I am on board with Gen Z when it comes to shorter TV episodes and shorter movies.
And I don't know where the coffee breaks and anything work-related fits in there. However, I would say that in terms of my Gen X habits, I'm probably going to stick with some of the longer form stuff here.
All right.
Just me.
All right, guys. Well, we'll have to come back to that conversation later. Coming up, Rivian slams the brakes on its EV van deal with Mercedes. Stay tuned to find out why. Rivian causing a jolt in the EV space earlier today, announcing it's pausing plans to develop an electric van with Mercedes in Europe. Rivian only signed the deal 3 months ago. It's just the latest development driving down Rivian stock. Shares of the company falling more than 70% this year alone. Joining us for more is Carl Brower, ICCars.com executive analyst. Carl, good to see you, man. Kind of a head scratcher here, pulling the plug so soon on this deal. What do you think happened exactly?
I think, unfortunately, Rivian has a lot on its plate right now. It got plant capacity that's almost twice what they're producing on the vehicles they're already supposed to be making. And you roll in all the problems we've had over the last couple of years between supply chain issues and the price and availability of things like lithium. It's very hard to produce these cars, and it's very hard to produce them at a profit. We've seen it across the entire electric vehicle industry.
Carl, what do you think this does for Rivian's global reach? Obviously, a huge setback to that, and for future growth opportunities there.
Yeah, I think one of the most impressive things we've seen from Tesla over the last 5+ years is how quickly they expanded outside the domestic market here, and how successful that's been and how beneficial that's been. Any electric vehicle maker is going to need to follow that same path for long-term viability, including Rivian. This would have been a great kind of stepping stone into more global reach and global markets. And I'll throw in too that I feel like these commercial developments, that's where really the EV technology almost makes more sense, right? I mean, consumers, there are consumer use cases where it makes sense, but when you talk about vehicles that go on a very predetermined, predictable path, typically they're coming home every night, to a hub where they can charge all night. They go out again on the same predictable path, and they're very urban oriented, which would have been a lot of the van production that we were talking about with Rivian and Mercedes. That's ideal for an electric vehicle. And so it's really unfortunate on that level too.
Yeah, Carl, the IRA really kind of boosting a lot of those tax incentives for the commercial vans, both light duty, medium duty, and also heavy duty. Do you think that's why we saw Rivian sort of get cold feet here with Mercedes, or is it more about the conserving cash that they so desperately need to kind of go forward in the next 2 years or so?
I think it's more of the latter. I think that they committed on the consumer side first. That's where they've put their priority up until this point. And I don't think they want to have, basically two battlefronts. They don't want to fight on two fronts at this point. And they feel like maybe if they could go back and redo it, they might reconsider the commercial versus consumer emphasis, but they're too far down the consumer side now. And if they start to divert the other way, it could not work out for them on the consumer side as quickly as they needed to, but cost them what they've built up momentum-wise on the consumer side. It might not work out on the commercial side if they go that way too.
So, Carl, I'm a little bit of an outsider here, so just help me understand. It looks like there was a game plan going into the pandemic. Things changed quite a bit. Supply chains got disrupted, and now they have different marching orders, want to go in a slightly different direction, but don't want to stray too far broadly from their original mandate because they have sunk costs invested in there. I mean, is that somewhat of where we are with Rivian right now? And just wondering, it seems like a lot of other companies in the space would be facing something similar.
They are facing similar problems, and some are managing it better than others. Tesla gets a lot of credit for how well they managed their production and productivity in spite of the challenges of getting these rare earth materials that they all need, like palladium and nickel and lithium, when the Ukraine conflict broke out. But some of them haven't been as successful at managing that, and all of them are paying more money now, and it's really making them have to reevaluate their business plan. If you may recall that Ford admitted that the Mustang Mach-E electric SUV was profitable when it launched, but then it wasn't profitable, a year later because of the elevated cost of producing it because of the raw material cost.
Yeah, Carl, speaking of that, we just saw, I want to pivot here slightly. We saw the government approving loans to GM and its joint JV with LG Energy with Ultium Cells to give them about $2.5 billion for new plants in Ohio to build these materials. This is sort of a slam dunk for the White House, right? You're getting money spent on manufacturing, union jobs, and then also you're supporting the EV industry. Is that how you kind of see it there? It's just like a win for everybody?
It's critical that we get domestic production back for some of these items, and electric cars and electric car components like batteries is a good example. And I think a lot of us kind of knew that, and a lot of us weren't happy with the loss of manufacturing in this country. But if we weren't aware of it before, I think the pandemic helped really cement the concept that maybe we shouldn't totally depend on other countries on the other side of the planet to deliver essential things that we need here, especially in areas that we're looking for long-term future growth, like electric vehicles. So it's a very good idea to support the domestic production of cars and battery packs. There's a lot of legislation that's passed in the last 6 months to do that, and we're starting to see the benefits from this latest deal with GM and LG.
Yeah, Carl, certainly the Biden administration taking a number of steps in order to boost EV production here in the U.S., but I think many analysts would argue that much more is needed over the next couple of years. What do you think is a more realistic or a realistic timeline when it comes to wider EV adoption here in the U.S. and an infrastructure system that can support that?
Yeah, that's the other big one, obviously, is that we just have to have the infrastructure, and it's very spotty, right? I mean, I'm in Southern California. I was using 2 different electric vehicle test cars in the past week, and I was happily surprised at how easy they were, including a run from Los Angeles to Las Vegas and back. And first time I'd gone that far in one, I was a little like, ugh. It was pretty painless, but I know it's not like that across the country for people. And so you've got a lot of stations that aren't working, they're vandalized, they just aren't operating, or there aren't enough and you get there and there's a line that you got to wait 20 minutes, an hour. I didn't run into those, but that's not true everywhere. We need to make sure that's true everywhere.
Oh, good to know that range anxiety at least may be on the downtrend. Thank you for that, Carl Brower. Coming up, Twitter Blue is back, but Apple users will need to pony up some extra cash for the blue check mark. Stay tuned to find out why.
Let's take a look at a couple stocks trending here. We have Oracle up almost 3%, the move higher coming in extended hours after the company beat Wall Street estimates on both the top and bottom lines. Revenue for the quarter totaling $12.28 billion. That's a jump of just about 18% on a year-over-year basis. Cloud was a standout in this report. Total cloud revenue coming in at $3.8 billion. We just talked to Dan Morgan, an analyst here that covers Oracle, saying that cloud is really going to be what's driving the company forward here as we look out into the future. CEO Safra Catz saying that Q2 was powered by our infrastructure and also applications to the cloud business over the past 3 months. We're looking at Oracle holding on to gains up just about 5.5%. Year to date, though, we're still looking at losses, although faring much better than the broader market with year-to-date losses of just about 7%. And let's take a look at Tesla, the stock falling once again today, closing off just about 6%. This number right here, 167.82, that's the lowest level that we've seen for Tesla in just about 2 years. It was the biggest dragger on the S&P and also the Nasdaq today. Year to date, this stock off just about 52% over the past 3 months. We're looking at losses of about 44%. Most recently, Tesla coming under pressure following reports that the company is going to be cutting production in Shanghai. That's a real concern for investors going forward. Again, we're looking at 44% drop over the past 3 months. Tesla today closing just below 168 a share.
Thank you for that, Shauna. And my data to watch for tomorrow is the CPI or Consumer Price Index. For the broader CPI number, the median month-over-month forecast is for 0.3% and 7.3% year over year. For the key core CPI number that takes out food and gas is 0.3%, and year over year that should be down to 6.1%. It'll be the last piece of inflation data the Fed will get ahead of their big decision on interest rates on Wednesday, and we're going to bring that to you, the live announcement here on Yahoo Finance at 2 p.m. on Wednesday.
Twitter Blue is officially back with a few upgrades. Yahoo Finance tech reporter Ali Garfinkel is here with the latest. Ali, what is Elon Musk and the new Twitter management doing here exactly?
So it's worth backing up. Hi, Pras. Great to see you. So it's worth backing up a little and just saying that Twitter Blue, first things first, it's Twitter's subscription service, and with it you get the ability to do things like edit tweets, post high quality videos, and of course you get that all important check mark. So what they're doing here is this. First things first, pricing is changing. Now it's going to be $8 a month for Android users, but if you are an Apple user, it is actually going to be even more expensive. It is going to be $11 a month. This is coming on the heels of, Musk's standoff with Tim Cook that seemingly has been resolved since then. It's also worth talking about checkmark tiers here, because there's actually, this to me is one of the key things. We're going to see really, really different check marks. You and I are used to just seeing the blue check marks. Now there's going to be a bunch of different colors. The blue verified check will now involve a verification process, and it will be part of Twitter Blue. The gold check is for companies, and the gray check is now for governments. I'll be totally real with you. My first thought was, this is going to be a lot of check marks. Bottom line, given how fraught the company's first effort at making this public was, there were issues with impersonation and misinformation. I have the sneaking suspicion that given that and given the turmoil of the company, this is not the last we're going to hear about checkmark.
Well, let me follow up on that, Ali. I have a blue check mark. I just checked it right now by my name on Twitter. Wanted to make sure it's right there. So is this going away tomorrow? What's the deal with this? I understand they got to raise subscription revenue, but it seems like there's a little bit of a game being played here. What can I expect from my personal blue check going forward?
Yeah, I'm going to be real with you, Jared. I think it's not entirely clear. As someone who doesn't have a blue check, yeah, shocking, right? As someone who doesn't have a blue check, I'm a little less worried about it personally, I will say. But I think that it's safe to say, Musk came out today saying he wants to get rid of all the blue legacy check marks, right? So I think it is safe to say that there will be some kind of change. It is unclear who that will affect and why. I would assume right now it's going to affect everyone, including you. But that said, again, Musk's tenure at the company has been eventful and sometimes unclear about what will happen next. So I would venture to say that, you have your check mark today. Maybe you won't have it tomorrow. Maybe you won't have it in a few months. But it's safe to say changes will keep coming.
Here today, gone tomorrow with the blue checks. Ali Garfinkel, thank you so much. In other Twitter news, Musk again confirmed that the character limit will rise more than 14-fold to 4,000 characters per tweet. Shauna, this is like an essay. What do you think about that? I think it's a bit nuts.
I think it's a bit nuts. I don't know. I guess it's going to really change how we use Twitter, at least on a daily basis. If you're going to be seeing more and more tweets with 4,000 characters, totally different than what we have been accustomed to. I think all these changes under Musk need to be taken with a grain of salt. We were just talking about the fact that so many of these changes or the ideas that he first rolls out goes through about 7, 8, 9, 10 iterations before he actually launches the product. You can say that with Twitter Blue, what Ali Garfinkel was just telling us. So I think Elon Musk is trying to figure out ways to change Twitter's business, trying to make it more profitable, trying to also expand the revenue stream beyond advertising, which we know has made up 90% of Twitter's revenue more recently. I don't know how much impact Twitter Blue is going to have. I don't know if raising the character limit to 4,000 is really going to attract more users to his site, but I think Elon Musk is floating out ideas, seeing what everyone's reaction is on Twitter, and then taking a step back and deciding what's going to be implemented.
When I was logging off Twitter last night, the last thing that entered my head was I would love to see long-form essays from every single person on my list right now. And that is, of course, not the case. I don't need more information from the people on my... Brevity is the soul of wit. That's why I got these guys here. I give a hard time to Elon Musk sometimes. Deservedly so in some aspects, undeservedly in others. I'll say from Jack Dorsey, he inherited an enterprise which was inherently resistant to any kind of change whatsoever. I've read about the decision-making process that Jack Dorsey goes through. It was on a secular time frame. It just takes a long time for things to get done. And so to change that entire mindset within a new company or within an existing company to a new mindset, I think is just going to take a little bit of time. So I'll give him the benefit of the doubt, although I'd like him to spend a little bit more time on Tesla.
I think it's very Valley-esque, right? To constantly be changing stuff, breaking stuff. Oh, that didn't work. Let's fix it again, do something new. So I could see why he's doing that. It's like kind of like the ethos of that whole area is you cannot be kind of like stagnant in where you are. But you're right. Jack Dorsey is kind of like what do you call it? A follow Marcus Aurelius, right? He's going to be like very it's going to be it's going to be a simple sort of product. That's how it was from the beginning. That's how it's going to be now. And Elon's like, well, maybe we can make it better.
Yeah, and Elon Musk clearly making his mark. He's already laid off over half of the company. More people have left because of the culture change, a culture shock that we have seen play out at Twitter over the last several months. So Elon Musk certainly making his mark on Twitter. Questions though remain as to what the direction is going to be with the company. And Jared, you brought this up before, but a big concern here from a number of analysts on the street, particularly those who cover Tesla, is that Elon Musk is spending way too much time when it comes to Twitter and forgetting about some of his other responsibilities. May not be forgetting about his other responsibilities, but simply putting them on the back burner, at least for now. And that's a big reason why maybe we've seen Tesla under pressure too.
Well, unless we're looking for Twitter to have its liquidity moment at $400, $420 a share. Okay, getting way ahead of the next IPO cycle right there. Got to go on that one, guys. All right. To Taylor Swift, sure, a pivot here. First, it was Taylor Swift fans. Now, fans of another popular artist have an axe to grind with Ticketmaster. Find out why when we return.
Ticketmaster is looking to right its wrongs with Taylor Swift fans. The ticketing platform is giving some verified fans a second chance to earn tickets to Taylor's Eras tour, notifying them of a ticket request opportunity via email. Ticketmaster apologizing for, quote, difficulties that fans had experienced when they tried to purchase tickets last month. They were asked to do this by Taylor's team. So Live Nation, Ticketmaster trying to right the wrongs. I guess it's a step in the right direction, but Pras, I think a lot of Taylor Swift fans are still going to be very disappointed that this is how it's played out. And clearly everyone who wants a ticket is not being notified. Not everyone got that email, and they don't have the opportunity to buy it.
And then you have to email Ticketmaster. I mean, what is this like? I'm gonna sort of fax them, say I want 2 tickets in center row, like MSG. And they said that they would have to see if those tickets are available at that price, and they'll fulfill them. It seems pretty complicated and convoluted. It seems like they're trying to throw a bone here to Taylor Swift fans that are pretty upset about what's going on. I don't know if this is the right response. I don't know if this is going to actually work. Because
maybe it's the right response, though. Let me just play devil's advocate here. If it's truly a bad solution and Taylor Swift is the biggest recording artist on the planet, maybe it's working. Maybe if she doesn't rock the boat that much, Ticketmaster and Live Nation are just going to get away with this for a longer period of time. If it doesn't happen with Taylor, guys, it's not going to happen at all. That's what I think.
Yeah, I don't know. I mean, I think there's lots of questions. We've heard from a number of lawmakers. They want to hear directly from Ticketmaster. They want to hear from Live Nation. They want to investigate, obviously, the recent merger, saying that has really caused a monopoly here. It's not a fair chance to so many fans out there. And this simply is not the only story that's going on with Ticketmaster right now, because Ticketmaster is trying to make things right with Swifties and now has another group of fans that are very upset at the company. On Saturday, this past weekend, the company publicly apologizing to fans of Bad Bunny. Now, this coming after an, quote, unprecedented number of people were sold fake tickets to the rapper's concert in Mexico City. Once again, Jared, fans not happy, and rightfully so.
If I made the trip to Mexico City because I'm a big Bad Bunny fan, and they're fake, I got serious beefs, not only with Ticketmaster, but Live Nation. Anybody who sold me the ticket, want to throw them all under the bus if possible. Look, this situation with Ticketmaster is not going away anytime soon. I've seen 30 iterations in my own lifetime, so we got to leave it there. In other news, FTX founder Sam Bankman-Fried will not be testifying before the Senate Banking Committee this week. Committee leadership saying in a statement that, quote, Bankman-Fried's counsel has stated that they are unwilling to accept service of a subpoena and that they will continue to work on a date to have him give his side of the FTX collapse. Bankman-Fried is still expected to testify before the House Financial Services Committee tomorrow.
That'll do it today for Yahoo Finance Live. Be sure to be back tomorrow at 3 p.m. Eastern for all your coverage leading up to the closing bell.